Hello, and welcome to our financial news broadcast here at Worldwide Economy News. In today's top story, Japan has experienced a significant drop in its stock market, prompting analysts and investors alike to reassess the current economic climate. In this special report, we will delve deep into the events that have led to this market decline, focusing particularly on interest rate changes as one of the main causes, and explore their implications for the Japanese economy and global markets. Let's begin with an overview of the current situation in Japan's financial markets. Over the past week, the Nikkei 225, Japan's benchmark stock index, fell by nearly 6%, marking one of the most volatile weeks for the index in recent memory. This decline has sparked widespread fears of instability within Japan's economic framework. The sell-off was broad-based, impacting major sectors including technology, automotive, and consumer goods, raising concerns among investors who had hoped for a stable economic recovery. Following the interest rate hike by the Bank of Japan, investor sentiment has quickly turned bearish. The impact of this downward momentum can be seen across various sectors, with major firms such as Sony, Toyota, and SoftBank all reporting significant losses in their stock prices. The sentiment in the market reflects broader anxiety about the future trajectory of the economy, as many are questioning the sustainability of current growth rates amid rising borrowing costs. The Bank of Japan has recently shifted its monetary policy stance, increasing interest rates for the first time in years. This move was largely prompted by rising inflation rates, which, while previously seen as tame, have begun to accelerate due to various global factors. Significant contributors include ongoing supply chain disruptions and increased prices for raw materials, which have affected not only Japan but many economies globally. The Bank of Japan adjusted the policy rate to combat inflation fears, raising it from negative territory to 0.25%. While this may seem modest compared to the rapid increases observed in other countries, the cultural and economic climate in Japan positions this shift as particularly impactful. The move signals a departure from the ultra-loose monetary policy that has characterized the Japanese financial landscape for over a decade. Analysts were anticipating the Bank of Japan to maintain lower rates to fuel economic recovery. However, the unexpected rate hike has rattled markets, showcasing how delicately balanced monetary policy decisions can be. The interest rate increase was initially perceived as a measure not only to curb inflation, but also to prepare the economy for a more stable foundation in the long run. Yet, immediate market sentiments have reacted sharply, reflecting concerns about the timing of such a decision. As we now review the broader economic implications stemming from the recent stock market tumble, experts caution that these developments may impact consumer spending and business investments significantly. Higher interest rates typically result in increased borrowing costs for both consumers and businesses, leading to a potential slowdown in economic activity. Increased interest rates usually mean more expensive loans for individuals looking to finance cars, homes, and various consumer goods. For businesses, higher financing costs could deter investment in expansion and innovation initiatives. This could set the stage for lower overall economic growth if consumers pull back spending due to tightening financial conditions. A slight increase can have large effects in economies, especially in countries with high debt levels. In Japan, where households have historically maintained substantial savings balances, the reaction to rising costs of credit could lead to a rapid cooling of consumer confidence. Many households find themselves in a precarious position, choosing between savings or spending, with the latter requiring careful calculation in the face of higher credit costs. The reactions within the market have been swift and severe. Major corporations such as Toyota and SoftBank saw their stock prices plummet in the immediate aftermath of the Bank of Japan's announcements. For instance, Toyota's shares fell by approximately 7% in just 3 days following the rate hike, a worrying signal for one of the world's largest automotive manufacturers. SoftBank also faced significant declines, with a reported drop of about 5.5% in the same period, attributed to fears surrounding its leveraged investments and the potential increase in costs due to higher interest rates. Investors have been particularly reactive, leading to a flight from equities towards more stable investment vehicles, such as government bonds and commodities. The volatility that has swept across the markets demonstrates the sensitive nature of investor confidence, particularly when influenced by monetary policy changes. The developments in Japan's market not only pose risks domestically, but also have broader implications, particularly for global markets that are still recovering from previous economic stresses. Japan is the third largest economy in the world. The significant movement in its markets can create ripples across international financial landscapes. The interconnectedness of global finance means that changes in one major economy can lead to immediate reactions in others. In particular, neighboring economies in Asia as well as global stakeholders are keeping a watchful eye. With China also facing its economic challenges, tensions could heighten as Japan's market instability influences trade and investment flows throughout the region. Additionally, with many countries also grappling with their own inflationary pressures, uncertainty in Japan's economy could compel tighter global financial conditions, affecting capital movements and altering investment strategies worldwide. Another fascinating aspect of the evolving market situation is Japan's sovereign bond market, also known as JGBs, or Japanese government bonds. Amid increased interest rates, the bond market has reacted differently. While the stock market is experiencing selling pressure, government bonds have seen an upswing in demand. Investors are seeking safety, turning to bonds despite lower returns. The rise in yields on Japanese bonds reflects the broader uncertainty and a shift towards safer assets amid the risks associated with equities. This flight to safety could have both positive and negative implications for the Japanese government. On one hand, a lower demand for bonds could drive up borrowing costs for the state. Conversely, strong demand for bonds can allow the government to finance its widening debt at lower costs, provided investors maintain confidence in Japan's long-term fiscal health. With growing impatience among consumers and businesses, questions arise about the future economic trajectory of Japan. Many analysts and economists are pondering whether the Bank of Japan will reconsider its tight monetary policies in the coming months. Given the sharp decline in market confidence, there is speculation about whether the central bank might announce further measures to stabilize financial markets. Some may call for a potential return to a more accommodative monetary policy should inflation expectations begin to diminish or consumer behavior show signs of contraction. However, any significant policy changes would hinge on upcoming economic data, particularly surrounding inflation, consumer spending, and employment rates. The performance of these indicators will dictate how monetary authorities respond to the evolving economic landscape. Segment 8. Consumer Confidence. At the heart of the economic rebound lies consumer confidence. Recent surveys have indicated a decline in consumer sentiment, with shoppers increasingly cautious. As the value of investments declines, households are likely to adjust their monthly budgets to prioritize essential spending. Experts predict that unless income rises substantially or the economic outlook improves, households may scale back on discretionary purchases. Consumer confidence is essential in driving domestic demand, which traditionally contributes significantly to Japan's overall economic growth. The government may need to step in to bolster confidence by introducing stimulus measures aimed at supporting individuals and small businesses. Historical precedence indicates that active government involvement in mitigating economic downturns can sustain growth momentum. Segment 9. International response and interest rate spread. The global response to Japan's rising interest rates will also be fascinating to observe. Central banks around the world, particularly in the United States and Europe, are grappling with similar inflation challenges. The interest rate spread between Japan and other major economies could lead to capital flows as investors chase higher yields. If rates in Japan remain comparatively lower than in the United States or other parts of the world, there may be a shift of capital away from Japan, further impacting the yen and potentially leading to greater volatility in local markets. As the situation continues to develop, it is clear that both investors and consumers will be keeping a close eye on the next steps taken by the Bank of Japan. The interplay of interest rates and market confidence will determine the short-term and long-term health of the economy. The recent drop in Japan's market serves as a stark reminder of the delicate balance that central banks must maintain in navigating economic growth and inflation. The next few months will prove critical in shaping the future landscape of Japan's economy, as well as its position within the global economic context. That's it for our special report. Thank you for joining us as we unpack the complexities surrounding Japan's recent market drop. If you enjoy this type of content, please don't forget to subscribe to the channel and activate the notifications so you are the first to know when I post a new video. Stay tuned for more updates on this story and all the latest market analysis right here on Worldwide Economy News.